Joining us to talk more about this, what to expect from the Fed this week, is Bob Michele. He is the Chief Investment Officer and head of the Global Fixed Income, Currency and Commodities Group at JPMorgan Asset Management. Bob, let's start with the FOMC meeting, because I don't know how closely you're following the tech moves that are here today.
Oh, I'm watching them pretty closely.
So what do you do?
I'm sure the FOMC is glad to see there's other news in the market that's not just them. This meeting should have been easy for them. Go in, point to the soft landing, playing out exactly as they had hoped. You have unemployment just above 4%. They meet their objective of full employment. You look at inflation. We look at the 3 and 6 month annualized run rate of core personal consumption expenditures. They're 2.3%. That looks pretty good. That's close enough to the 2% target. And then you also look at perhaps the real Fed funds rate is a little bit higher than they'd like to see it, but inflation's not quite at their target. That looks okay. And then you have all this policy noise coming out of Washington, and that's the big issue for them. How do you deal with that? How will they weigh that in their decision-making process?
Well, do you think they will bow to that? I mean, the market is kind of anticipating that they will, and I think you think this is the case too, that they will pause and this will be an extended pause.
Yeah, they'll pause. They've made no indication they'll do anything but pause, and they should. Wait out the next couple quarters, see how the data plays out, and be comfortable where they are. For them to cut rates further from here, they'd have to see material weakness in the labor market, and that doesn't look like it's coming.
If they did cut rates this go-around, what would you think, given the political pressure to do so?
I'd be really surprised. I'd wonder how committed they are to their inflation target of 2%, and how could they ignore the policies that are being talked about in Washington?
Ignoring the policies, I wouldn't anticipate that they would ignore policies, but it's kind of hard to make policy decisions based on policies that haven't really been formalized at this point.
And yet cutting rates is making a policy decision.
Okay,
doing
so standing pat, doing nothing
to me is the obvious thing for them to do. The economy is in great shape right now. They probably would have stood pat anyway, regardless of the noise coming from D.C.
Okay, as you mentioned, it's not just noise from D.C., it's also noise coming from the markets this morning when you see not just tech stocks that are down double digits, but also energy stocks as well. Everybody reassessing what it means to have DeepSeek out there.
Yeah, and it's also good to be a bond investor when there are yields back in the market again, because they can serve as the anchor in the storm. That's what we've seen this morning. There was a flight to quality, the safe haven. The Treasury dropped 12, 13 basis points to 450. It's hard to do that when it's 1%.
So you're feeling pretty good just because it's making your wheelhouse look like a better place to be?
Yeah, it's making our clients' lives a lot easier. They've underallocated to fixed income over the last couple of years for very good reason. They were getting good yield in cash. Equities were doing well. Why put money into a fixed income market which had low yields and where yields were rising? Now they see higher yields. They could put money in the aggregate bond market at 5%. They could put it in high yield at over 7%. You can go into bank loans at 9%. That helps them achieve their objectives.
Because technology may not be the generator that we've seen in stocks over the last year plus?
Well, from a fixed income standpoint, it could also be disinflationary, and maybe that's what we're seeing from DeepSeek, that there are cheaper ways to do things. Bond markets will like that.
Yeah, I guess you look to what happens longer term with this, too, what it's going to mean for productivity.
It should be really good. The Fed targets wage gains of 3.5% to 4%. We're kind of in that sweet spot now. They think 2% of that 3.5% to 4% is inflation. The balance of 1.5% to 2% they like to see from productivity gains. It looks like we're going to continue to see those.
Okay. So happy days for you?
Feels like it, certainly today.